Rules of thumb can help to simplify complicated topics, and that's often helpful. After all, there are only 24 hours in a day, and you're a busy person, so you might just want to know what time it is without getting into exactly how the watch is built. So let's take a look at some of the most popular rules of thumb for retirement, and we're going to look at some of the advantages and disadvantages of using them. So on the one hand, they can certainly oversimplify things, and that can cause you to make decisions that are maybe bad or even just less than great. But on the other hand, we don't want to dismiss them entirely because there could be something valuable in each of these rules. We'll start with that notorious 4% rule, possibly one of the most popular rules of thumb for retirement planning, and basically it helps you figure out how much you might be able to spend in retirement or how much you might need to save to be able to retire comfortably. The way the rule works is it says you take 4% of your retirement savings as of the date you retire, and then you can plan to withdraw that amount each year and adjust that amount upwards each year with inflation. You're invested in a 50-50 mix of stocks and bonds or something like that, and if all goes well, the idea is that you should not run out of money over a 30-year time horizon. So if you retire at age 60, that would presumably get you until age 90 if the rule holds true. Now, there's definitely nothing guaranteed on this planet, and you can still run out of money even if you use the 4% rule or even a more conservative version of it. So let's look at an example. Let's say you have $1 million on the day you retire. To follow this rule or this guideline, because it's really not a rule, it's a research finding, you would plan to withdraw $40,000 in your first year of retirement. That's because that is 4% of $1 million, and we're just using round numbers here to keep the math easy. Then, if inflation is 3% for that first year, you would add 3% to the amount you withdraw in the next year so that you can maintain your purchasing power. So in this example, we're going to withdraw $41,200 because we have that 3% inflation increase. And then in subsequent years, again, you would look at inflation and adjust your withdrawals so that you're keeping up with inflation. The 4% rule is a result of some research done by Bill Bengen long ago, and he wanted to figure out what is a safe withdrawal rate. And by safe, what he was looking at is if he goes into the worst case scenario of historical data, what is the withdrawal rate that you would have used? And it ended up being 4% in the worst case scenario. But there were many other scenarios in which the withdrawal rate could have been higher. The merits of this rule are hotly debated elsewhere, and the study has evolved since the initial publication. For example, he has looked at what if you use different asset classes? Does that help things out? The answer seems to be yes. But we're just going to focus on some basic pros and cons right here. I've got other videos on that topic, but for now, it's important to know that this guideline or this research finding could help you figure out how much you might be able to draw from your retirement savings each year. So again, if you've got $1 million, 4% rule, that might mean $40,000 per year. If you want to be more conservative, you can say I'm going to do a 3% withdrawal rate and make that $30,000 per year. Alternatively, let's say you want to figure out how much you would need at retirement to generate an income of a certain amount. So let's say that amount is $40,000 per year of withdrawals. In that case, we would take 25 times the $40,000 for a result of $1 million. And that's kind of the 4% rule in reverse. We're essentially using the same concepts to get to a similar answer. This can all be helpful if you have absolutely no idea how much money you might need in retirement. So some people assume they can withdraw something like 8% or 10% or more every year, and that's probably unsustainable. So by starting or anchoring yourself on a lower rate, even if it's not the perfect rate, you might be able to keep your expectations realistic. But at the same time, this way of looking at withdrawals is far from perfect. It ignores the fact that spending in retirement can be lumpy, so you might need to buy a car or repair a roof in some years, while other years are relatively uneventful and a flat withdrawal rate doesn't really cover that. There's also no accounting for taxes, so pulling $40,000 from a Roth IRA is not the same as pulling $40,000 out of a pre-tax retirement account. You're left with a different amount to actually spend depending on where you take the money from. We're also ignoring different spending patterns here. Most people don't spend in that flat inflation adjusted, always increasing pattern. The reality for most retirees is quite different. I've got other videos on that, but you might experience the go-go, slow-go, and no-go years. That's, for example, when you spend quite a bit more in your early years of retirement, you're in good health and you want to do all those things you dreamed of, but then your spending slows down somewhat as your health and energy decline. And then at the latest stages in life, your spending increases quite a bit with healthcare costs. There's also that retirement spending smile, which might look somewhat similar. You can also potentially start with a higher rate than that 4% if you're willing to adjust your spending during market downturns. So if you wanted to take your chances a little bit and possibly improve your experience in the early years in particular, then you could maybe start higher, but you would have to make some cuts if the markets misbehave. Hopefully those would be temporary cuts, but you just never know. Another issue is that the flat withdrawal rate doesn't account for strategies like a Social Security bridge, and that's where you retire and then you spend from assets at a relatively high rate before claiming your Social Security benefits. So it might be several years or more. And then after that, the rate drops. And in the meantime, you benefit from growing your income from Social Security, and there might also be some tax advantages and other benefits of using a strategy like that. And finally, we have to remember that you might not live through the worst case scenario. That research was done on worst case scenarios, and in fact, things might go well. If returns are strong, and there's no guarantee of that, of course, you could potentially withdraw more, and those dollars could help you enjoy life or be more comfortable or make more memories. In fact, in some cases, many cases, you'd be expected to die with more money than you started with if you follow a 4% rate using sort of historical data. Again, the past does not predict the future and anything's possible. You could certainly run out of money quickly, but it's important to know that things could go well, they could go badly, they could go somewhere in between. So you need to balance these desires to live well with some prudent behavior that can account for unknowns about your health and longevity and market returns. So the bottom line here is to use the 4% rate or any other rate you pick just to see if you're in the ballpark. And if you will be far away from that, then evaluate why. It could be perfectly fine to withdraw quite a bit more or less, but you need to be able to explain or justify the reasons for doing so. Next is what some people call the rule of 100. So how much risk should you take as an investor during retirement? One rule of thumb that some retirement savers lean on is taking your age minus 100 to determine how much stock you should have in your portfolio. And like the other rules of thumb, this has pros and cons. On the one hand, it can make sense to reduce risk as you age. That's because you have less time to recover from market downturns and you're more likely to be taking withdrawals as opposed to just adding to your accounts and waiting decades before you take the money back out. The conventional wisdom is that having a substantial amount of your retirement savings in stocks can be risky due to the sequence of returns problem. And that is if the market crashes around the time you retire or just during the early years of your retirement, then every withdrawal you take takes a meaningful bite out of your assets. And as a result, you may have a higher risk of running out of money. But at the same time, this rule of thumb assumes that everybody's retirement situation is the same. And certainly different people have different circumstances, and it might be appropriate for some to take more or less risk. On the one hand, you might not need to take much risk at all, and that's because you're already secure, so what's the point in taking a lot of risk in stocks? You can take it kind of easy. But on the other hand, and by the way, that's kind of the view of if you've won the game, then stop playing. But on the other hand, you could say that you can afford to take risk because you're not withdrawing from your assets. And in that case, maybe it makes sense to put more money into stocks because it's unlikely that you'd be taking losses anytime soon. Or what if you have cash reserves set aside for market downturns? There are certainly pros and cons of doing that. And, over the long term, you might lose out to inflation a bit, but that might be the solution you choose and want to go with. Similarly, you might use a bucketing or a time segmentation strategy for risk management, and that's also far from perfect, but it's kind of a different way of looking at things, and so this rule of 100 just wouldn't apply in the same way. There's even some research to suggest that you should actually increase your stock exposure as you age, and that's known as a reverse glide path or a rising equity glide path, and that might possibly work out better than a strategy that gradually reduces risk over time. No guarantees, of course. You could still run out of money, but something to consider. So, as with any other rule of thumb, you can use this to take your temperature. And if your stock exposure is dramatically different, then that's not necessarily bad. But the important thing is to notice it and ask yourself why. Or some people will say maybe make it a rule of 125, which would tend to lead to higher stock exposure. But at some point, if you're just going to keep changing the rule, then maybe you just do away with it altogether. Next, we have the rule of 72, which tells you how long it takes money to double in an account. But first, I am Justin Pritchard, and I help people plan for retirement and invest for the future. And in the description below, you're going to see links to some of the information we're talking about here, so you can check it out yourself. There's also some general retirement planning information that I think will be helpful if this is a topic that's on your mind, so please be sure to check that out. Also, a friendly reminder that this is just a short video. It's not covering everything. You really need to do a lot more homework so that you can reduce the chances of things going badly. Again, the rule of 72 tells you how long it takes a number to double, and that might be appealing if you want to know how long it will take to build up a desired level of savings. For example, you might have $500,000 now and you want to have $1 million in 15 years. So if you're curious whether or not that's feasible, the rule of 72 might help. So there are at least two ways to use this rule. One is to divide 72 by your expected annual return, and the result is the number of years it takes an account to double. Or you can divide 72 by the number of years until you'll retire, and the result there is the annual return you would need for your assets to double over that time period. Let's do an example. You will retire in 15 years, and your calculation suggests that you'll need twice as much as you currently have. So what rate of return would allow your accounts to double? To get that answer, you would divide 72 by 15, and the result would be 4.8%. That may be helpful, but it doesn't tell the whole story. So the rule here assumes that you'll get the same return each period, which is unlikely with most types of investments that most people use. You can't necessarily predict or control your future returns, and they vary over time. But, some fixed income investments might offer enough certainty to do some calculations. There is also the issue of contributions. So if you're still adding money to your retirement savings, your accounts can double faster. For instance, if you deposit $20,000 per year, in the example above, you'd reach the 1 million mark about 5 years earlier. And of course, you have to account for inflation. So do you just need 1 million or do you need an inflation-adjusted 1 million? So ultimately, this is also an imperfect rule of thumb for retirement situations. Like the 4% rule, it ignores taxes and what types of accounts you have and other things, but you can still use it to make some quick estimates of how a particular account might grow. The amount of spending to budget for is always a big question, so some of your expenses might change at retirement. They might shrink while others might grow. And of course, inflation is going to affect different categories of expenses in different ways or at different speeds. So one rule of thumb for retirement budgeting is the 80% replacement ratio. And the exact level varies. Some people would say you need to spend between 70% to 100%, but it really could be much more or less. The rationale behind a replacement ratio that's a little bit lower than 100 is that your needs could change at retirement. If we start with your pre-retirement gross income, some things are going to go away. For example, you're no longer paying payroll taxes, and you'll no longer need to save money for retirement, so you don't need as much income to support those savings. You might also not commute or eat out as much if that was part of your workday. And while those are reasonable assumptions, it's probably too simplistic to assume that you'll need less and much less to put a number on it. And while those are reasonable assumptions, that's probably a little bit too simplistic. In reality, you might need significantly less or more, so it's best to do robust retirement planning with your specifics in mind. So you might want to be mindful of your lifestyle and your location, your health, and other factors. Instead of basing that goal on your pre-retirement gross income, it could make more sense to use your spending today as a foundation for any estimate. So you can make a detailed budget if you're that type of person, or you can make some estimates that are based on your income and your taxes and your savings levels and kind of do a top-down type approach. And I've got other videos on that. And from there, you might make some assumptions about how things would change in retirement. Again, you'd want to consider those go-go, slow-go, no-go years or the retirement spending smile. And this video popping up here is going to discuss the reality of retirement spending for many people. So I hope you found that helpful. If you did, please leave a quick thumbs up. Thank you and take care.